Hi, this is Mike Lembeck with Remax Commercial. Today, I wanted to go over three new articles on Let's Talk About It and kind of dig into the real estate market a little bit further on what's been going on just lately with some of these articles in the news. So let's get started. All right, so the first article we have up is study. California has more tenants per apartment unit. 56% of the state's 5.7 million renting households are burdened by rent costs. So right now, what we're seeing is the California has more tenants per unit than some of the nation's highest and some of the nation's highest rents. That puts it among the worst places for renters in the U.S., according to a new study. A rental survey of 50 states plus the District of Columbia ranked California the third worst place for renters behind Nevada and Arizona. As we know, the rents have been going up dramatically over the last 2, 3 years since COVID, and it's just a high demand for rentals. And landlords have been increasing rents anywhere from 20 to 25% or more throughout most of Southern California. So that's put a huge burden. These are the numbers showing us, what a burden this is on tenants, and how hard it is for them to afford the rent. So the California tenants saw the sixth biggest rent cost inflation in 2016 through 2021, up 27%. That's considerable, especially when you're looking at most lenders and who are, when they're looking at a buyer for a loan, they want a 30% payment amount, 30% of their income going towards the mortgage payment. And it's kind of the same for renters, but I know a lot of landlords that are doing, they're increasing that at 35, 40, 50% sometimes, because that's all the prospects that they're getting as far as for tenants, potential tenants. The lofty rent expenses left 3.2 million California tenant households financially burdened, defined as those with 30% or more of income going to housing costs. In California, 56% of tenants were defined as burdened by rent compared to 51% nationally. So we're 5% higher than the majority of the United States as far as our burdened tenants for the payment of their rent. Tenants in California make up 40% of households in the 40, I'm sorry, tenants in California make up 44% of the households in the state. So you've got almost 50% of the households in California that are renters. And if you've got 50%, or roughly almost 50% of those households burdened, you've got a huge problem in the economy, and a lot of changes potentially coming forward if we don't see rents kind of come down a little bit, or at least at this point stabilize. And I think that has happened for the most part. Tenants are just being priced out of the market when it comes to rents. Okay, the next article we have up is the U.S. real estate market in big trouble, expert warns. Basically, we've got this Capital CEO, or Pulte Capital CEO, Bill Pulte, has been saying that when you have a rise and increase in interest rates like we've had, this is a big problem for housing. Interest rates are like the mother's milk of housing. And if you cut it off, you're in big trouble. And when you have had these massive increases in interest rate, it just puts a lot of things to a stop. So basically, the market has pretty much, because of the interest rate increases, has really seen a big pullback from investors and the amount of sales. All the stats are flipped from what they were last year. How inventory is down still a little bit. Overall, the days on market has increased. The number of transactions is down pretty much all across all of Southern California. So, basically the mother's milk has been cut off, and I don't see that changing here in the short term. I think what we're going to see is sometime if we see an interest rate decrease, we're not going to see any activity pick up until quite a few months after that. I think interest rates have got to drop considerably before we start to see anything as far as a turnaround in the housing market. Next up is the Fed's ongoing housing market reset sees buyer cancellation rate at one of the nation's largest home builders spike to 68%. So Jerome Powell was asked to clarify what he meant when he said spiking mortgage rates would cause a housing reset. The meaning, he said, was that the housing market would slip into a difficult correction. We've had more than just a difficult correction. I think we've had quite a dramatic correction based on the recent stats. We've had a we had a time of a red hot housing market all over the country when famously houses were selling to the first buyer at 10% above the asking price even before seeing the house. That had happened quite a bit, multiple offers. People were looking at the photos and then writing an offer based on the photos without ever stepping a foot through the door. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level and at a reasonable pace, and that people can afford houses again. So that is already kind of taken place as far as the pace of housing sales has dropped dramatically, along with multifamily, of course. And I think we still don't see the affordability level there. Prices haven't gone down enough for that affordability to be absorbed by the interest rate or the price reductions to be able to be absorbed by the interest rate increases and the cost overall of money for a potential buyer. We probably in the housing market have to go through a correction to get back to that place. But with but from a business cycle standpoint, this difficult housing correction should put the housing market back into better balance. Yeah, it's going to be a long road before we see anything as far as the correction. Again, per my last statement in the previous article, we've got a ways to go. Interest rates have got to drop considerably before we start to see any amount of correction and people feeling a little bit more comfortable about things. Of course, this is so-called difficult. Of course, this so-called difficult housing correction has already arrived. On Wednesday, KB Home announced that its buyer cancellation rate in the fourth quarter of 2022 spiked to 68%. That's up from 35% in the third quarter of 2022 and up from 13% in the fourth quarter of 2021. So quite a dramatic increase in cancellations. Historically speaking, a 68% cancellation rate is off the charts. Even during the darkest days of the 2008 era crash, the average builder cancellation rate only reached 47%. So quite a bit of a difference there, a 21% or 21 point increase in cancellation rates in relation to what they were at the height of the 2008 era crash. So I think we're headed for some pretty tough times even here in the future as far as potentially cancellation rates going, staying about at the same. What ends up happening is the builders have to reduce their inventory, and they're not going to reduce prices. They're going to offer incentives like interest rate buy downs, a lot of perks as far as some of the flooring perks, different things that they can offer that they get as far as through their building process of the home that they can mark down and not have to show a decrease in value based on sales comparables, because they need to keep their prices up in order to be competitive with the previous buyers that purchased, and then also make sure that they're selling their inventory at the highest point that they can. All right, so that wraps up this today's let's talk about it. The three articles that we just went over are showing quite a bit of what's going on with the market and what we can anticipate moving forward. If you have any questions on any of the information or want to discuss your own individual situation on potentially where you could invest and or potentially sell your current asset and avoid paying capital gains, a lot of different ways to do that without having to do a 1031 exchange. So give me a call, send me an email. I'd like to talk to you about that. Any questions that you might have on that whole process. I've got a lot of contacts with that part of the business that you can have a lot of experience there that can help you navigate that process and feel comfortable about going about it. So let me know what you think in the comments, and love to hear from you, and looking forward to seeing you again on the next one. Take care and have a great day. Thanks.